I'd say it all comes down to mentality. I have friends that start at the same time and are much further ahead of me, right? And then I have other friends that were slower to the gate, right? And so the first one, and I'll talk to what it is that we brought it, and for a year we just really got the process, make sure we knew exactly what our formula was, right? And so the first one became a really big success. And so we used that success to really just amplify us to do the next opportunity to start building momentum, right? So instead of just saying, hey, let's just buy a bunch of properties and we'll figure it out, we got really dialed in with the process. What syndication is, and you can use syndication to buy, a golf course, you hear syndicated radio shows. What it is you're pulling resources from investors. So you can go out there to buy a larger asset so you can all benefit from the kinds of scale. Because typically if it's, say, like an apartment building, if it's a large apartment building, it might be too much for one person to go out there and buy it by themselves. Or if we say they could, it might take up all of their capital, right? But there's so many benefits with multifamily. You have, the ability to get cash flow, to get appreciation, both from hopefully the good market you pick, but also through forced appreciation, depreciation benefits, tax advantages, debt pay down. There's all different reasons why multifamily is a great asset class. So many people want to get exposed to it, but also still want to have a small exposure compared to maybe potentially what they have in a lot of their other assets, stocks, bonds, et cetera, right? So as they look at this, syndication gives them the opportunity to take advantage and participate in an offering, right, in a multifamily investment and get potentially some of the benefits from it. Instead of putting down hundreds of thousands of dollars or millions of dollars, maybe $50,000 or $100,000 can be their slice of the pie, where they'll still get those benefits partaking with the rest of us here. Part of the syndication is there's typically managing partners and limited partners, or general partners and limited partners. I act as the general partner. I basically find the deal, put the deal together, make the relationships, close the deal, operate the deal, right? I'm taking on all the parts of signing in a loan, making sure the property is meeting expectations, all investor communication. And then we'll have investors that will come invest with us, right, as passive investors, right? So they'll come in there in a limited capacity. Their upside and their downside risk is based on their investment, right? So they're not signing on a loan, they're not going in there in part, so they're able to get their returns based on what they invest. However, they are in a limited fashion, right? Meaning that they're passive, they have no usual say in operations here, or voting rights in what they do.
Perfect. All right. So hopefully every one of you kind of grabbed that, but it is a way for you to really scale and scale with not a ton of money. Because can you imagine how much 2,700 apartments would cost? But if you're getting into a syndication, you can come in at like he mentioned, a limited capacity, but still sharing all the things. The upside, you can share in the depreciation, the cost segs if they do those. There's a lot of benefits to syndications. Now, let me ask you, in the last couple of years, things have been a bit crazy. The markets have, I don't even know where to start and stop, but let's just say it's been crazy since the pandemic. We were in the lowest interest rate cycle that just seemed like it was never going to end, with tons of money in the system, to now we had a big inflation problem, which the Fed tackled or is trying to tackle with raising rates really fast and aggressively, which has just crushed a lot of people. And it not just banks. Banks are on life support. If you haven't figured that out, folks, banks are on life support. Maybe not the big commercials, although they're still struggling a little. You just won't hear about it. The regionals are really having a difficult time. And I'm not going to get into why, but if banks are having a really difficult time, that would basically mean that other businesses that need financing from banks are also having a really difficult time. Syndications, from what I've heard, I've talked to probably hundreds of people that are in syndications. Some of them have been really struggling because usually there's an exit, right? These people come into a syndication. Usually there's some type of an exit, if you will. You call it different things, but it's either a sale or a refinance. So investors pull money up, you buy the property, you renovate the property, make it nice. There's kids playing outside. And then at that point, the value goes up on the property. You take it to the bank and you refinance, and everybody can get, most of their money back, sometimes all their money back. And the whole time they got paid a return on their money. What I'm hearing today, and I'm asking you because you have enough units where you definitely have to be seeing this or feeling this on some of yours, is, are banks literally shutting you down when you're going to get financing for these properties? Question number one. Question number two, in this high interest rate environment, when you do have bank financing, all commercial bank financing has a rate lock. It's usually 5, 7, maybe 10 years, but now we're far enough into this game where we're starting to get to that cliff where rates are, getting to that maturity, and they're not maturing at 4 or 5% anymore. They're maturing at, and I just did one the other day at 7.98%, which is double in some cases what people were getting before. So let's just start with those two. How are those two dynamics affecting syndications and specifically your syndications?
Well, there's just a rate and value relationship, right? So as interest rates are higher, it brings down rates and values overall, right? So the valuations that you potentially went into years ago, right? You have to see that you have to accumulate so much upside value to accomplish for a factor to be able to go to sell to someone today in today's market. Most of our projects are in 5 or 7 year cycles, and luckily in the forecast, we only have one project that has a floating rate. And we had a cap that basically a rate cap, which basically is something you purchase as insurance just in case interest rates go up, right? That was the only property of all of our deals that we had on a floating rate. So we've basically been in that rate cap, right? We've been in that almost since closing. The rest of them, we have just fixed rate. We made the decision. We started going to fixed rate. We started moving a lot actually to banks, and banks, there's not a lot still lending, right? A lot are still on the sidelines because it's hard for them to price deals, right? Because they're like, oh, how do we price this today? Because they don't want to get capped on how they're putting their money out, right? But they just don't know with the certainty because there hasn't been any certainty. Because then you think about COVID, right? COVID was interesting because COVID happened, right? And there was so much uncertainty, but then people got used to the uncertainty of COVID and then they started coming back to the table. But right now, when we have today's environment, you have, Ukraine war, you have Israel, Palestine, you have, all this crazy economic factors and the rates, you have, bridges getting knocked down. You have all these different things that just keep coming out, these like black swan events. And then you have this part where the Fed's trying to get inflation under control. And all that's happening, they're like, yeah, we're jacking up rates, but now we finally got some good employment data today. But in terms of employment, unemployment still staying very low. The job market still staying very strong, right? People are still, living, doing their thing, still out spending stuff, right? You're still having all these factors that are driving away, even though potentially we might see some of inflation coming down. There's been so much money put out in the market. It's hard for us to look at this today and say, okay, we have a clear vision of where this is going. So now, March, potentially a couple months ago, we were going to have rate drops. Now, potentially, June, July, but like maybe not 3, maybe 1, right? There's no clear vision of where we're going. And so when you look at that, there still seems to be so much risk out there in the market. The banks are like, okay, I'm just going to hang out for a little bit, right? I'm just going to sit in the sidelines, or I'm not going to have so much allocation to certain industries, right? To certain asset classes, right? So, for banks, some are coming back to the table. We've done a couple of deals with banks here, but for us, when we look at this, I'm trying to do deals with banks, even though they might not be the best terms, right? So if you go get agency financing with Fannie or Freddie, typically that's going to be some of the best terms. Like they're very proactive. They lend to multifamily. They have to go out there and lend to multifamily. So typically you get the best term, right? The best rate, the best amortization, potentially some interest only if you want. The downside is that because of how they're pricing it, they have an expectation on how the money they're going to make. So there's a prepayment penalty that's usually pretty prohibitive on those deals. So if I put a 5-year or 7-year deal with them and lock into a loan with them for 5 or 7 years, and I want to go move the loan in 1 year because rates have dropped or just anything has happened, well, it's going to be very costly for me to exit that deal because of the prepayment penalty. Well, if I go with a bank, right? So we just did a deal with a local bank here. I might not get the best terms, right? Just like you said, like 7.98, right? We just had a deal like in the high 7s. It's a 5-year deal. We get 1 year of interest only, and the amortization is 25 years. The plus side to that is that if things change, right, and in my favor, let's say rates drop, right, or rates level off. I don't think we're going back to where we were, but let's say prime today is 850. Prime historically has always been 550. So let's say we come somewhere in range, wherever you want to call it. We come down from the highs we've seen in the last little bit. Well, with a 1% prepayment penalty at the bank, I can go capitalize on that. I could potentially sell, or I could go refinance the agency at that time, right? So it gives me more flexibility, although it's more pricey. So for that, we've been trying to really take into account flexibility with the deals that we've been doing and just with our current deals, because it gives us the opportunity to react to the market instead of being stuck into the market. Because when rates dropped tremendously, back 2020, 2021, you would see all these people, because of just a high increase of valuations, trying to get people to assume their loans. But their loans were, you get a 4% loan and their loan would be like 8%. And you'd have to assume it. And if you would buy it at the pricing they want, you'd be at like a 45 or a 50% LTV. It just made no sense. And so my concern is if I lock into a loan today with so much uncertainty out there, that I'm going to be on the other side of positive when I want to sell, because rates would have dropped. My loan won't have value out there in the market, and I'll be stuck, because for me to sell, it's going to cost me and the project a tremendous amount of money to exit on the deal.